The Federal Reserve spent some time today doing something that they normally don't do, admitting openly how uncertain they are about their own models, their inflation trajectory, even their understanding on how AI is reshaping the entire economic system. And what's wild is that while the Fed's out warning about uncertainty, the actual data that we got today paints a picture that's even more confusing. So we've got PMI with growth and sticky inflation pressures, declining consumer sentiment, another update from the BLS, and we can't forget about the massive surge of money flowing into the inverse NASDAQ fund from these traders betting on a market sell down. So today we're going to be breaking down all of that, what the Fed said, and I think we should start off on Vice Chair Jefferson and why he says this time is different. So let's begin. Philip Jefferson is the vice chair over there at the Fed, and he gave his speech on AI, the economy, and financial stability. He really laid out one of the clearest frameworks on how the Fed is viewing and thinking about AI today. He let us know that the members of the Fed see AI as massively boosting productivity, and it's already doing it for the sectors like customer service, logistics, programming, medical research, corporate operations. But at the same time, it creates this slack. Because if these companies replace workers faster than new jobs appear, that's not a good sign. And then they talk about how younger workers who are less experienced, haven't been in the workforce as long, they're most at risk because companies are faced with this decision. All right, we're going to have to invest either way into a workforce. Does it make more sense to invest into human labor? It might be a good worker where they might show up late all the time, on their phone all day, call in sick, need the holidays off, or AI, which works for you 24/7, doesn't complain. You could pay it less. So there's just a balance off there. And the inflation impact regarding AI, it's a little different because it lowers prices through better efficiency for some goods and services, but then at the same time, it drives certain costs up through massive demand that it creates for like these data centers, for example. Energy costs go up because these data centers need energy and a lot of it. Then land's scarce and these data centers are massive. High skilled labor. But Jefferson says that them at the Fed, they need some time. Don't laugh at them while they're trying to figure this out. They need humility, time to learn, because this is a structural shift that they just can't model yet. They need time to figure it out. And this is critical because the Fed has this dual mandate. They want maximum employment and price stability. And those are on opposite ends of the scale. It usually moves like this. Well, what happens when AI, and it does, pushes on both of these factors and hard? So Jefferson then highlighted this stat from the Fed's financial stability report, and he talks about how 30% of market participants now say a turn in AI sentiment is the top risk for the US financial system, which is up 9% from the spring survey. That's up 9% since April, a threefold spike in fear in just 6 months. And the worry's pretty simple. If AI expectations unwind, financial conditions tighten, credit dries up, economic activity slows down. So there's a whole deal with that, and this matches exactly what we're seeing in markets today with huge concentration and these huge expectations and huge exposure based on all of that, which brings us to the dot-com question. So Jefferson, he says that this isn't the dot-com bubble. This time is different. The most dangerous words in investing. But he has 3 reasons he sees that being fit. Mainly starting off with dot-com firms not having real earnings, but the firms we have today, they do. So these dot-com bubbles, most of them had barely any revenue. It was mainly debt and they were just lighting money on fire. But the leaders today in the AI space versus these internet companies back in 2000 in the 1990s, these are your large tech names today, and they have real revenue, real profits, real cash flow, real demand. And then he gets into talking about PE ratios, these price to earnings ratios, and how, yeah, they're pretty high right now, but they're nowhere near these .com levels. .com valuations, they were completely insane, and today's names, they're high, but it's not like extreme bubble territory high. And then the .com had thousands of public companies that just slapped internet on the stock name, and then it like went surging a ton. Today's ecosystem, like we have 50 major players, like yeah, that's a lot, but it's not thousands of them. So AI speculation, it exists out there, but it's not every company slaps AI in its name and it rallies 500% error. But he does warn that AI firms are now issuing more debt and a lot more debt. And then if sentiment turns, losses could amplify a lot. So in short, we aren't in a .com 2.0 from his point of view, but we are in something that's systemically important that does need monitoring. And then we heard from Lori Logan today, and her message is that the Fed isn't necessarily sure that policy is restrictive anymore. They're pretty much saying they don't know that rates, where they are right now, are doing enough to defend inflation. So Dallas Fed President Lori Logan delivered the most practical clarity today that she preferred that September cut, but she didn't necessarily support cutting in October, and that we already made 2 cuts this year. We really only should have did 1 in her opinion. And the reason why is because inflation is still high and they forecast it to be higher for longer, above 2% until 2030 according to this blue chip consensus outlook. So that's not good. And then they view policy as not being very restrictive at all, with PCE inflation expected at 2.7% next year, further away from the Fed's target, putting the real Fed funds rate at only 1.2%, which is barely restrictive in many models. And then she gets into talking about how, well, if policy was so truly restrictive, why are asset values soaring? Because right now, markets shouldn't be performing this way if policy was tight. So it must not be that tough out there. And then talks about how rate cuts from here on going forward, they need to move extremely cautious. And her bottom line is that the Fed probably needs more data before she's going to support cutting. And they won't cut in December unless inflation falls faster than expected or the labor market cools more rapidly. And I don't even think we're going to get much more data between now and December 10th. And the Fed's about to go into their blackout window. Which brings us to the crucial part. Today's data didn't necessarily make the jobs for the members of the Fed easier because they're still differing. John Williams came out and his message was that tariffs, not labor, are the reason inflation is stuck. So New York Fed President John Williams, he made a huge point. He said that tariffs boosted inflation by 0.5 to 0.75 percentage points. And he notes that there's no second round effects of inflation from tariffs, wage growth is moderating, labor market gradually cooling, supply chains aren't constrained, and he believes inflation does return back to 2% in 2027, which is a complete differing view from Lori Logan, which in his opinion does give the Fed room to cut if needed. But then the PMI data we got today, it shows that the economy is still growing. The S&P Flash PMI for November showed the composite coming in at 54.8. That's a 4-month high. Services came in at 55. Manufacturing at 53.6. Orders strongest since last December. Business confidence highest in nearly a year. But input costs, those are rising the fastest in 3 years. So tariffs again. And manufacturers built their largest unsold inventory in 18 years of data. That's a recessionary signal if demand slows because now they're stuck with all of this stuff on the shelves. And then we got consumer sentiment data. It just keeps on coming today. Michigan Consumer Sentiment Survey of Consumers, that index came in at 51, which was near historic lows. That's down from 53.6. People hate high prices. Personal finances are deteriorating. Buying conditions for durables are plunging. Wealthy households lost sentiment as stocks dropped. and then they went up and then they dropped and now they're still dropping. So a record number of Americans are applying for credit cards right now. Happiness rankings are at all-time lows. Credit card APRs are at 24%, store cards at like 30%. Americans are financially strained is what this data is showing us. And then the BLS came out and confirmed no October CPI, no October unemployment rate, no standalone October jobs report. So everything merges into December. So December becomes CPI plus PPI plus jobs plus Fed meeting plus GDP revisions plus corporate guidance all in 1 month. So expect volatility just like today, like now, where the market's reaction hinted at this relief rally, but there's massive hedging growing underneath. So today, the NASDAQ, that one jumped up 0.88% over here. Then the S&P 500 up 0.98%. The Dow up 1.08%. So all indices ended out the week green. Bitcoin ended up down 1.87%. So that one's still falling. But the hidden story, real quick, let me back out and let's look at this real quick. Boom. $12 billion poured into SQQQ, the 3X inverse NASDAQ ETF. SQQQ. Let's look at this real quick, y'all. So we're going to go to Webull, and we're going to type in SQQQ. Wow. Let's zoom out a little bit. So it's fell massively, but then $12 billion just poured into it. You see that little baby spike right there? What's that? What is that saying, y'all? This is the biggest bearish tech bet in ETF history. So investors, they're hedging aggressively. So then economists are weighing in because now people are wondering, all right, y'all, are we in a bubble? Like, what's going on? Valuations of the Mag 7 forward PE, price to earnings ratio. We just talked about what Philip Jefferson thought about that. But the PE ratio for the Magnificent 7, 27. The dot-com bubble is 50 plus easily. And then concentration, AI accounts for almost all S&P 500 gains. Equal weight S&P is just up 3.8% year to date. So if we are in a bubble and it bursts, some predict that the possibility of a 30% S&P drawdown are what's to be expected if that happens. And there are risks due to AI and its extreme capital intensity, intensive in nature. There's these huge energy needs, shortage of AI labor, thin profit margins, enormous startup burn rates because you got to figure it out just like the members of the Fed right now. Because there's no model for it. We're trying to do it from scratch. So this is why sentiment is fragile. So what we have right now are and you can imagine the data is showing up, inflation's coming in sticky, consumer sentiment's kind of falling a little bit. Logan does not want to cut rates. She didn't even support cutting rates last time. The CME Fed Watch tool fell at 69%. Blew over 50, everybody. All the way up to 69% for the December 10th meeting for a 25 basis point cut. That's 0.25%. We'll probably fall back down to 50-50 because my bet was we'll land at 50-50 and then everybody's going to be like, are they going to cut? So markets, they think the Fed's going to blink and go on ahead and cut, but the Fed kind of made it clear today. They just might.